Good morning, Shane, and welcome to this special Hong Kong edition of Blue Notes. This morning you've announced the sale of the retail and wealth business in 5 Asian countries to DBS. This was a profitable business. Why have you sold it?
Well, it's all about focus. It is a profitable business. Actually, it's a good little business, and it's a business we've been investing in for some period of time. But, you know, the world's changed, and the rules of operating have changed in many of the markets around the region. It's got much more complex to run a regional platform. So we decided when we looked and said, we've got to put our limited resources, whether it's capital, technology or people, to work where they can do the most good for our customers and our shareholders. And unfortunately, that's not really in the retail area in those countries.
So you've said things have changed, and if you contrast this to the 2007, 2008 period where we really started to scale this business up, you know, what are the key things from your point of view which are different then versus now?
Yeah, so really the financial crisis, we're still living in the aftermath of that, and it's come in many, many forms. One is prior to the financial crisis, when we decided to really scale that business up, as you said, the world view and what we were seeing was regulators around the world were harmonising, getting more and more similar. Well, that makes it a little bit easier to run a regional platform when the rules are the same. Actually, what we've seen in recent times is that's not the case. That actually local regulation is going off in different directions for good reasons, and I understand all that, but that's raised the cost. We have issues like the FATCA, which is a tax legislation coming out of the US, which places more and more cost and complexity on operators like ourselves. So it's really just the rules of engagement have changed. Frankly, also even competition. It's got a lot harder. The competition is much more professional than it was, even in that short period of time. Technology, allowing new entrants, all of that stuff. So it's just really raised the bar in terms of complexity.
There were a couple of notable countries which were missing from today's announcement. I guess I'm thinking of Vietnam in particular. What's the situation there?
So this is a transaction that is 5 individual countries rather than necessarily looking at them all as a whole. And Vietnam is still going through its review. So we're still having a look. It's a little bit more complicated in Vietnam because of the rules around what new buyers can acquire and how they do it. So that's still under review.
There was a loss of $265 million on this transaction, which was probably a little bit of a surprise to the market. Can you explain what was behind that?
Sure. So there was a profit on the sale itself in terms of we sold the assets, if you will, of this business for a little bit more than book value. So that's a good thing. The loss that we're booking really relates to the cost of unwinding the business. As I said, it's in 5 countries. We've got sort of systems, technology costs, and those are really what is driving most of that unwinding cost.
So I guess the question on everyone's lips out of this is, does this start a retreat from Asia for ANZ? Well, what's the plan for Asia going forward?
Absolutely not. This is not about retreating Asia. This is about focus. And all good businesses continually sharpen their focus about where you're winning, where you're doing well, and where you can do better. And this is about our focus on the institutional bank. Really core to our strategy is servicing the trade and capital flow needs of our customers in this region. You know, we still remain very, very excited about those opportunities. Trade and capital flow in this region is growing much, much faster than GDP. We have a small share of that. We happen to be really very, very good at it, and that's what we want to focus on. So Asia is critically important to our strategy going forward.
I guess even in institutional, we're shrinking risk-weighted assets, we're seeing a tighter focus on our customer base, and there have also been some job losses across institutional as well. What sort of business are we really trying to build in institutional?
Well, that's the same theme. Even in institutional, it's all about focus, and it's about focusing on those customers that want the services that we provide and are prepared to pay us fairly for those things. And so we are going through a review. And, you know, again, it's all about being really focused where you can win. And we can win in things like trade finance, debt capital markets, and foreign exchange and cash management. So those are the areas, and we've got to find those customers that want to buy those things and not buy other things from us.
The final issue is the minority investments in Asia, which there's been a bit of speculation about on and off, and you described those earlier in the year as non-core for ANZ. What's the plan there, and what can we expect in the next few months?
Yeah, and perhaps first just remind people why we say they're non-core. They've actually been a really good investment for our shareholders. But the reason they're non-core in my mind is that none of our customers benefit from us owning those minority stakes. And frankly, none of our shareholders come to us to invest in ANZ to get exposure to them. So that's why I describe them as non-core. We've said we want to progressively release capital from them through selling them. Today we're focused on what we're doing in Asia around this retail and wealth business, and we are making progress on those minorities. It's slow and it's complicated, but I'm actually looking forward to making some positive progress on that in the next financial year.
Okay, thank you for joining Blue Notes, Shane.
Thank you.